a massive rate hike has just been announced. This is how it's going to affect you. Hey everyone, welcome back. Special edition of our podcast and YouTube channel here, as the Bank of Canada has just come out with a 100 basis point, a full 1% interest rate hike. This is a surprise. This was not expected. What was expected was 0.75, which, while that is quite high, a full 100 basis points is more, and is the biggest move they've made in 24 years. This is going to have major ramifications, especially in the housing market across Canada, and definitely here in BC, in Vancouver, where real estate prices are the highest in the country. Quick look back here. We started this year at 0.25% overnight rate. We have seen 4 hikes since. We are now at 2.5%. Big changes, and in a very short amount of time. This is changing the whole landscape. We are here today to go over it a bit. We've got a mortgage specialist, Mychal Ferreira, from the Bank of Montreal here as well. Ryan, why don't you touch a little bit on why rates are going up so much so quickly?
Yeah, I mean, this is more of the inflation fight, right? We are fighting rising inflation. In fact, I know at least in Canada, we saw the last print at 7.7%, but the USA came out today at 9.1%, which means that Canada's inflation rate definitely is going to be higher come July 20th. So, I suspect some of this move to go to a full 100 basis points is because they have knowledge about where inflation is going come the 20th, and they need to deal with it. Central bank has estimated that inflation will remain above 3% until 2024, meaning interest rates are probably going to stay elevated until we have control of that. Understandably, higher rates mean lower prices for homes. Buying power is just getting wiped off the table right now. And a lot of people are thinking, should I wait until prices come down? And, well, your buying power is also getting eroded at maybe even faster pace than prices are coming down. We've already seen prices begun their decline, but I suspect with a 100 basis point hike, we're going to see some more extreme cases of price drops and bigger price drops across the board, generally speaking.
Yeah, it's all but guaranteed in the short term. If you look already, I mean, we've had 4 months of price declines here in Vancouver. We're down 13% from the peaks in March, or back in February. The decline started in March. So we're down 13% already. That was before today's 100 basis point hike. This is going to further erode buying power and further erode pricing. It just will. It has to. It's the biggest effector on real estate prices is interest rates. Okay, so let's get into this and how it affects you. There are essentially 3 groups of people who really want to be paying attention to this. People that have variable mortgages on their homes, people who are looking to renew their mortgage in the near future, and of course, those who are thinking about buying a home and are about to get a mortgage. So to discuss this in depth is the #1 mortgage specialist for Bank of Montreal across Canada, Mychal Ferreira. He funds hundreds of millions of dollars of mortgages every single year. He has a wealth of knowledge, and he is here to help kind of dispel some myths maybe, but also talk some hard truths, because we are in interesting times. So Mychal, thank you so much for being here today. We really appreciate your time, because I know how busy you must be today.
Thanks, guys. Always a pleasure to be here. And obviously, yeah, big surprise today. I think everybody was thinking that it would be a 75 basis point. I don't think anybody saw a 1% increase. And, the sentiment today definitely has changed. We are seeing a little more panic ensue, but, it's important that, that we understand exactly like what it means to you as a buyer, as a person renewing, as, anybody with a mortgage that has a variable component. And just to kind of dive into a few things, I think one of the biggest changes I feel that's happened today is for prospective home buyers, right? So if you are thinking about buying a home, today would be the first day that your qualifying rate will have changed. So prior to this point, we've been getting away with using the minimum stress test rate of 5.25%, despite the fact that rates have been going up. It never hit that threshold to cross that. It did with the fixed rates, as fixed rates crossed a while ago, because the average fixed rate is, generally speaking, anywhere between the low fives to the high fives, right? So the stress test says that you take whatever the greater of 5.25 or your actual rate plus 2%. So if you're at 5.5%, you add 2%, you're qualifying at 7.5. So people in general have not been using the fixed rate when all of this started happening, right? Because, fixed rates are have been climbing for some time, and they're they're on a whole different metrics, right? Whereas the variable, because we've been under 3.2, 3.3, we never really crossed that 5.25 until today. So, if we're looking at a generally normal, averaged variable discount, you're now qualifying it over 6%, right? So that's a big jump to go from qualifying 5.25 to 6%. In fact, likely it's going to be more than that for most people. But that's about a 7 or 8% change in buying power overnight for everybody, across the board. And I think that's the biggest kicker, I think, initially for prospective home buyers, that we'll instantly start seeing across the board, for sure.
Got it. Okay. So let's do a quick analysis here. For example, if you have a $100,000 a year salary, what could you qualify for in January before all the hikes compared to today?
So, as I mentioned, of course, because we've been using the same stress test for the last, forever since it was implemented, your qualifying was the same. It was about $100,000 you could borrow, give or take about $575. That's just using an average, cost for the property and the actual stress tested payment. As of today, that same $100,000 gets you about $530,000. So, 100, 575, 100, 530, literally overnight. So, back to your point, Ryan, about, although prices are dropping, buying power overnight just changed 8%, where we've had 13% since March changes in the market. So
that's right.
I think if you compound those, I think there's going to be a bigger change coming, but definitely, that's, one of the things that we're going to have to start looking at when we're applying for mortgages.
Well, and I also think, like, for the average variable rate holder, for example, if we go back to, say, January of this year, which wasn't that long ago, and we look at your interest that you were paying on your mortgage versus, say, the principal that you were paying, that has shifted significantly based on where we're at now versus where we were even just 6 months ago.
Yeah, let me share some figures here, because I think, this is kind of shocking, but, using an $800,000 mortgage, which is usually the average mortgage size that we tend to do in Vancouver. So a fixed component, start with fixed just to give you a little bit of a look into that. So fixed in January, you're talking about 2%, right? Fixed today, you're at 5.5%. So, your payment today a payment in January for an $800,000 fixed would be $2,953. As of today, at 5.5%, you're at $4,481. Right?
Whoa.
Wow.
Yeah.
Mychal, that's a 50% increase.
Almost. Yeah, that's pretty aggressive. And the variable, which has always been the cheapest option, right? So an $800,000 mortgage for, I think 1.29%, you're at $2,679. Whereas today, at about 4.04%, you're at $3,822 a month, right?
So you're up roughly $15,000 in the cost of your annual mortgage overnight.
Yeah. So the biggest thing, obviously, is we're looking at the people who are applying now that are getting these, the people who are getting renewals, right? And that's the shocker here is anybody that's renewing is jumping up right? Whereas people who are jumping in, these payments may not be palatable, and they might have to be reduce their purchasing power as well, right? Just to have a payment that's comfortable, right? But when you look at the overall what you're paying towards interest in versus principal, I mean, in January, 70% of your payment was going towards principal. Is now you're lucky if 20 to 30% is going to principal. So,
wow.
Big changes will definitely impact the mentality of the buyer, of the person applying, of the person who has a maturity coming up, right? Is it better to...
I also think it might need to, people who are selling their homes, maybe trying to buy something else, you need to understand that what people could afford 6 months ago is no longer what they can afford now.
No.
Right? And it's going to have an effect on prices.
It's definitely much more difficult. And also just lenders across the board now are going to be a lot more, stringent in how things come together, because what the outlook for the next few months, if you were appraising a property today at $3 million, well, what's that property going to be worth in 3 months, right? So, risk is going to play a bigger part in lenders' decisions these days. So, now more than ever, if you have a pre-approval that's already been put together, and it depends on how you've done that pre-approval, you may need to revisit before offering, just to make sure that things are the same, that you're grandfathered into the old stress test. Because if not, I mean, I see a lot of people who, I've been pre-approved even before we saw this, but now it's going to be way more prevalent. I was approved for X, and then they go to make an offer, and then, it turns out I wasn't, right? So, those are things that we want to look out for sure.
Got it. Okay, so let's expand here a little bit more on people who have a fixed payment variable rate mortgage, because things are changing a lot for them. Like you just mentioned, the amount of payment going from to their principal has just been eroded from 70% at the beginning of the year down to 33%, but their payments are still the same. Or are they? What may happen here with this trigger rate potential issue for people, and how did they navigate it?
Okay, so I mean, right now, trigger rates have always been there. It's just that we've never had to talk about them till now. So if you have an adjustable rate mortgage, your payment will change every time the rates change. So nothing really you need to do. You're going to be impacted immediately. If you have a line of credit, again, your interest only payment will change immediately, right? And those are sometimes, tougher to deal with because you don't have a choice and it happens immediately, right? Now, for people who have a static payment variable mortgage, basically from the day you started your mortgage, your payment hasn't changed, even though when you look, you can see the rate has changed. What's happening there is that your proportion of principal to interest is shifting more towards interest with every increase. And when we're seeing these massive increases, that's a big shift towards interest, right? And a trigger rate basically comes in when your payment is now, the interest that is owed exceeds that payment. So basically your payment doesn't even cover the interest owing, right? And typically what happens is when that is very, very close to happening, you'll get a letter, or your lender will, notify you in a way saying, here's what's happening. You need to adjust your payment. You need to increase your payment or make a lump sum to kind of bring things back into check, right? And that is basically where most people are right now. Trigger rates have, in general, from what we can tell, have not been hit yet, but we are so close. And if you have this type of mortgage, now is the time to increase your payment. Make a change now, because what we've seen, even subtle changes to rate to payment, will push the trigger rate farther out, right? So it's better that you kind of understand what works for your budget, increase your payment, you're fine, versus getting a letter once you've exceeded that by 105%. So once your payment, you've now far exceeded the amount of the payment towards interest, you will be mandated to make that payment, right?
That sounds scary.
Yeah. Well, the thing is that people need to be educated in this. I mean, they need to understand that you have prepayment options. That's why these are there in the first place. And, at Bank of Montreal, we have 20% payment increases on both lump sum and payment increases. It's very easy to solve this problem. Go and bump up your payment, see what you can afford. Obviously, maybe it takes away from something else, but you don't want to be told that you need to put down X amount of dollars by X amount date, when you're talking about your property, right? You want to have control over that situation.
Yeah. For sure. And let's keep in mind here too, there are 3 more rate announcements this calendar year. Okay. We've got September, October, and December. Right now, the next 2 announcements are currently estimated to be an additional 0.5%.
Yeah.
So whether that happens or not, to be determined. But again, it's more likely that they will go up than they're going to go down anytime soon. So for people that are listening that have that variable rate mortgage, make some prepayments, get ahead of it. Because like Mychal said, you don't want a surprise letter from the bank and an unexpected expense that might be harder to cover in 3, 4, 5, 6 months from now. Then it might be starting to plan for that payment today.
Yeah. And, while that means the average consumer is going to be paying off more debt in their, with respect to their property, that does also mean that we're going to see the economies further slow in terms of what else they can spend their money on, right? So in a big picture, first of all, manage your own asset, right? It's your responsibility. Don't let the bank have to manage it for you, so get ahead of it. And 2, realize that it's going to have a greater impact in terms of how people are also going to spend their household budgets, right?
For sure. And Mychal, what's in your opinion, did the stress test protect buyers for this situation we're in today?
Absolutely. There's no doubt about it. I mean, if we were still qualifying people by their actual, rate, I think that's something that would be scary right now, because if we were qualifying people based on 1.5% or 2%, when we're touching 4 to 6%, I think that's a bigger shock. But qualifying people 5.25% means that we've done some sense of due diligence there in protecting against this, right? We are lucky. A lot of people tend to, well, why does the bank ask this, or why do we do what we do, and why do we have all these steps that we take? And I think it's becoming a lot more understandable, right? And protecting the individual from sometimes themselves, right? Because when you're buying a home, it can become so emotional, right? And sometimes you can push yourself into situations that maybe you can't afford. So having the stress test there and having all the due diligence we do, really, I think is what's keeping this whole thing afloat right now, right? And although, there's a lot of doom and gloom, I think that it will just be a little bit of a storm we have to weather. I don't foresee any major, collapses. I think generally speaking, people have the ability to control some sense of their payments and budgets and get through this, right? So I think that's why we are where we are.
Mychal, let's explore that a little bit then, because a lot of the phone calls I've been receiving today is, should I reach out to my mortgage broker and move to a fixed rate? And that unfortunately, a lot of people like security, but that might not be the best move, generally speaking, when you look beyond maybe the near-term effects of trying to control inflation, right? Maybe let's speak a little bit to what you would recommend. I mean, you kind of already touched on it a little bit in terms of increasing your payment to avoid a trigger rate, but what does that mean instead of moving to a fixed rate?
So, changing to a fixed rate, all that does is you're going from, okay, let's say you're at a 4% variable after today. So you're saying, okay, well, I'm going to go to a 5-year fixed or a fixed rate at 5.5% for security, for the sense of security that it won't go past that. Okay, so that's, another 1 to 1.5% in increases, right? It comes down to the individual here, but I mean, in my logic would be, well, instead of committing that extra 1.5 in extra interest overnight, why not increase your payment and put that same amount towards principal, right? And get ahead of these rate increases anyways, instead of saying you're going to basically just tack that on as interest. So, I think you're better off paying your principal, pay yourself first versus, pay the bank and pay the interest for the sense of security, which may not, and then you're trapped in this fixed rate for years to come. Right?
Well, that's what I was just going to touch on. I mean, if you get into a 5-year fixed rate, and if you look at, say, CMHC, for example, who's saying, well, things are going to slow down in 2023. They're going to pick up again in 2024, and we're likely going to surpass the recent highs in terms of prices in 2025. But if you're locked in at a rate, let's say that's like you're saying, 5, 6, 7%, and you can then get a variable at 3 something in a year from now or 2 years from now, you're going to pay a massive penalty to get out of that mortgage, right? Huge.
And we saw this when rates came down during COVID. People were paying tens of thousands of dollars in penalties to break their 2.5%, 3% mortgages. What do you think they're going to do if they're carrying a 5% interest rate? They're going to pay anything to get out of that, right? And the variable is in the history has always been the play. It's just right now going through this kind of roller coaster ride. I think it makes it harder and harder to make sense. But we're already hearing about not just CMHC. RBC was one of the first banks that says we'll be in a recession next year. They're pricing in cuts already, right?
Yeah.
And I truly believe that we're going to go through a little bit of a tough time here, but it'll go the other way. It will go the other way. And you do not want to be in these massively high fixed rates when things come down, because just as quickly as you're affected overnight, you're affected on the way down overnight too.
Yeah.
Right.
Yeah. So, and we still have housing shortages. We still have 450,000 permanent residents coming here every year. We struggle as a nation to provide 270,000 housing starts a year. I mean, if you do the macro picture here, owning property and weathering this inflation storm is kind of the way you should be managing this right now, and not panicking and making a poor financial decision.
Absolutely. I think right now you gotta, everyone needs to stay calm and look at the numbers and understand it. And, if you don't understand how your mortgage works, reach out to the person that helped you get it. And and if you're not happy where you are, reach out to someone else. Have a conversation, have it make sense, and make an informed decision based on facts, not on everyone else's emotions.
Hysteria.
Makes sense. So, Mychal, for those people that are already in fixed mortgages, do they need to make any changes right now?
Honestly, if you are one of those lucky people who have a fixed mortgage that's under 2%, consider yourself extremely lucky and make extra payments. Because every dollar you're putting, more than 70% of it is going towards principal. But I mean, every dollar you make as a prepayment, 100% of that's going to principal. So you really want to try and knock that thing down while it's very, very cheap. And, that's going to have an impact on the long term. I would kind of tell everybody. And one of the strategies that I implement and I tell people to do is, it's very easy to increase a payment. I mean, Bank of Montreal, you go online and you go and you increase it. Click on your mortgage, the amount you want to increase, click, done. And we're not talking you need to increase it $500, $600, $1,000. No. Do $50, do $75, do something every year or every 6 months. Because what ends up happening is you don't notice these small increases with time. And next thing you know, you're paying all this money extra to your principal, reducing your amortization by years and saving you thousands of dollars in interest. So I think, everyone can benefit from that, not just the people in variables that are going the other way. So, and not enough people use that. I think when you think prepayments, you think big lump sums. You don't think that I can bump up my mortgage $50 and the impact that has.
Or Mychal, a lot of people are like, hey, instead of paying an extra $100 a month, I'm just going to keep that $100 a month. And well, it's true though. I think a lot of people think that. And they're like, I'm going to hold on to that $100. I'm going to hold on to that next $100, next month. But we're dealing with inflation here at least in the States at 9.1%, right? So every month that $100 is now 90, then it's 80. You know what I mean? So that that erosion of you holding on to your cash is a false pretense in terms of what you could actually be doing for your total debt service.
Absolutely. I think we've been lucky enough to have these low rates. I think a lot of people need to capitalize a little bit more on it. And I think that there's a little bit more coming. I mean, I think there's 3 more increases. So, that $100 in your pocket may turn around on you if you don't put it to use.
Good to know. Okay, so we're sitting here at 14-year high interest rates. Understandably, a lot of people are likely going to be renewing in the near future. What do you advise to people that are looking at the horizon saying, oh no, I have to renew my mortgage in 6 months, 8 months, whatever it is. What do I do today to prepare for that? And what's it going to look like on the other side?
So if you have a mortgage probably within the next 6 months to a year, it's time to start having that conversation. You have to see what your payments are. Can you afford them? If you can't, maybe there's a conversation for a refinance, kind of stretch your amortization out, increase your cash flow, consolidate some debt, whatever the situation is. But if you are nervous about your payment going from a currently low rate to a significantly higher rate, I mean, even the variable, like I said, is 4%. You want to start looking at that now, especially if you're within 6 months. If you're within a year, you're probably gonna have to pay some form of penalty to get out. But if you're within 6 months, even your own bank will allow usually early renewals within 6 months with no penalty. So have a conversation now.
Great to know. Okay, Mychal, thank you so much for your time today and for all this very valuable information. For our listeners and viewers that want to get a hold of you and maybe have a conversation, explore how they can best protect themselves and prepare for their mortgage payments, how did they get a hold of you?
So you can reach me by phone, by email, or reach me on Instagram as well.
Okay, perfect. We will include all that information in the comments below. Thank you as always, for watching and listening, and we hope you found this beneficial as well. If you know somebody with a mortgage, please share this episode with them. We are here to help, okay? And don't panic. Thanks so much. Have a great day.